Welcome back to the deep dive. You've probably seen this before. You look at a fund and it's called something like the Dynamic Opportunity Portfolio or the Creative Growth Fund.
Right.
And you realize those names tell you absolutely nothing about what's actually inside. It's like financial camouflage.
It really is. So our mission today is to give you the decoder ring. We want to show you the blueprint for how these funds are actually classified, no matter what the marketing name is.
Okay, so we're cutting through the noise.
We are. Our sources, they lay out the structures used by bodies like the Canadian Investment Fund Standards Committee, the CIFSC. And for you, the investor, the goal is simple.
A shortcut.
A shortcut to an accurate comparison. If you get the core classifications, the actual ingredients, you can gauge the risk before you put your money down.
All right, so let's unpack that system. The CIFSC uses 5 major asset classes: cash, fixed income, equity, commodity, and other. Those are the building blocks.
They are.
Oh.
But like you said, that created portfolio fund, it might be 90% equity, high risk, high volatility.
And you'd never know from the title.
Exactly. And that's why classification is just the foundation of suitability. You can't match a fund to your risk tolerance if you don't know what's in it.
So you have to bypass the label.
You have to.
Right.
You dig into the fund facts document, you look at the top holdings. If you know you've got a low tolerance for risk, you need to be sure you're looking at a fixed income fund, not an equity fund.
Okay, so let's start at the absolute safest, lowest volatility end of the spectrum: capital preservation, cash, and fixed income. What's that safety net look like?
Well, the base level is the money market fund. By definition, these have to invest at least 95% of their assets in cash or, cash equivalents.
Things like Government of Canada, short-term bonds, treasury bills, that kind of thing.
Exactly. Very short-term, very reliable debt.
It sounds incredibly secure. But we know security always comes with a trade-off in investing.
It does. Money market funds, they offer the lowest risk, but correspondingly a very low rate of return. They're really for parking your capital safely, not for generating wealth.
Okay, so what's one step up from that?
That would be bond funds. They fall under the fixed income class, holding various bonds and T-bills.
And what's fascinating here, I think, is that even within fixed income, the risk isn't just about who issued the bond.
Right. It's about the time remaining until it matures. It's about duration. That's the crucial insight, and our sources break it down very clearly. Short-term funds hold bonds maturing in less than 3.5 years.
Okay.
Medium term, that's between 3.5 and 9 years. And long-term funds hold bonds that mature in 9 years or even longer.
So why does that timeline matter so much? What's the risk in a long-term bond fund versus a short-term one?
It's all about interest rate risk. Long-term bonds are way more sensitive to changes in interest rates. Think about it. If you have a bond that's locked in at a 3% yield for 15 years, and then rates suddenly jump to 5%,
your bond is suddenly not very attractive.
its market value plummets. Nobody wants that old, lower-yielding security. So the longer the duration, the higher the volatility from rate changes.
So there's an exception here, though. You mentioned fixed income funds that try to get a better return.
Yes. And this is where we get into credit quality risk. These are often called high yield, or less charitably, junk bonds.
Junk bonds.
Right. So instead of investing in stable government or high-grade corporate debt, these funds chase higher returns by buying debt from companies with lower credit ratings.
Which means a higher risk of default.
A much higher risk of default. They offer a higher interest rate, sure, but that possibility of the issuer going bankrupt introduces a kind of equity-like risk into the fixed income world.
Okay, so that sets the floor. But for an investor who's decades from retirement, wealth preservation isn't enough. We need to talk about capital accumulation.
Right. And for that, we have to pivot pretty dramatically to equity funds or growth funds.
And these are all about stocks.
Stocks of publicly traded companies, income trusts. The goal is dividend income, but really it's mostly about capital gain selling shares for more than you paid for them.
And this is definitely the high-risk, high-reward zone. But even if a fund holds hundreds of different stocks, there's another layer of risk to watch for, isn't there? Industry concentration.
That's where diversification can be a bit of an illusion. A fund might hold 100 different stocks, which looks great on paper.
Right.
But if 80 of those companies are all in the financial services sector or all in tech, that fund is incredibly vulnerable to industry-specific problems.
So if a new regulation hits the banks or there's a chip shortage,
the entire fund suffers at the same time.
Our source material has a great fictional example of this. A Canadian equity fund where the top holdings are almost all major banks. Bank of Montreal at 7%, National Bank at nearly 6%, Royal Bank also near 6%.
And that shows you diversification within a sector. But if that whole sector faces a headwind, all those top holdings are in trouble together.
Which leads us perfectly to fine-tuning that equity risk based on company size, market capitalization.
Or cap. This is a critical factor because, as a general rule, the larger the market cap, the lower the investing risk. You're basically trading explosive growth potential for stability. And the size spectrum is huge. It goes from mega caps companies over $200 billion all the way down to nano caps.
Which can be less than 50 million. But the common ones you'll see are large, mid, and small cap.
And the examples from May 2022 really drive this home. Royal Bank of Canada is a large cap at over $140 billion.
A massive established player.
Then you have Air Canada, a medium cap at about $6 billion, and Extendicare, a small cap at around $650 million.
So when you choose a small cap or micro cap fund, you're deliberately signing up for higher volatility.
Absolutely. A large cap company has established revenue, deep reserves. A nano cap company could, double its stock price in a month.
Or go bankrupt just as fast.
Let's shift to the funds that try to bridge that gap, the strategic combinations, starting with income funds.
Income funds are mostly based on fixed income. They're looking for stable, regular interest payments, but they're often blended. Blended how?
They might hold some high-quality stocks to generate dividends and maybe some capital appreciation on top of that stable interest. So they're generally a lower risk option than a pure equity fund.
And then you have the true hybrids, balanced funds. These are really the poster children for balancing growth versus safety.
Exactly. A balanced fund invests in both stocks and bonds to sort of average out the risk. But the name itself tells you where the balance tilts.
A balanced growth fund versus a balanced income fund.
Right. Balanced growth will lean more towards stocks, maybe 70-30 so, more risk. Balanced income will lean toward bonds, maybe 80-20 less risk.
Perfect for someone who wants that equity exposure but doesn't want the full roller coaster ride of a pure stock fund.
That's the idea. And the example holdings really show that mix. You'll see a Government of Canada bond right next to Royal Bank of Canada stock. It's a physical picture of diversification.
Okay, now for the set it and forget it investor, we have target date funds.
The mechanism here is genius in its simplicity. You just pick a date, say your retirement year 2045, and the fund manages the risk shift for you automatically.
So it starts out more aggressive with more equities.
Exactly. And then over time, it automatically rebalances toward lower risk assets like fixed income and bonds as you get closer to that target date.
That makes a lot of sense. Your risk tolerance naturally decreases as you get closer to retirement.
It's a fantastic behavioral tool. It takes the emotion out of that asset mix decision. That's why it's so popular and often the default option in employer pension plans.
Let's quickly touch on dividend funds. What's the specific appeal there?
The key incentive, especially for Canadian investors, is tax efficiency.
Tax efficiency.
Dividends from Canadian corporations are taxed at a lower rate than the interest income you'd get from a bond. It's because of the dividend tax credit.
So what does that actually mean for my take-home money?
It means if you get $100 in dividends from a Canadian stock, you keep more of it after tax than if you got $100 in bond interest. It makes them really appealing for income seekers, especially if you're in a higher tax bracket.
Okay, let's dive into some specialized categories, starting with property. We need to be really clear about the difference between mortgage funds and real estate equity funds.
They are completely different animals. Mortgage funds hold the debt. They hold residential, commercial, industrial mortgages. So the key risk there is default risk.
The borrower not paying.
Right.
Yeah.
Whereas real estate equity funds, they own the property. They have to invest at least 90% of their assets in actual buildings or land.
And the risk there is different.
It's illiquidity risk. You can't sell a skyscraper overnight if the market tanks. So if investors rush for the exits, the fund might have to halt redemptions.
So they're strictly for long-term investors who can handle their money being tied up.
Absolutely.
Yeah.
Moving on to passive strategies, you have index funds. A perfect mirror. It buys the exact same stocks in the exact same proportions as an index like the S&P TSX Composite. The manager's job is just to mimic the index. The risk is whatever the risk of that underlying market is.
And what about a fund of funds?
It is exactly what it sounds like. It's a fund that invests in other funds. You're buying into the expertise of several different managers and getting more diversification. The risk is just the combined risk of all the funds it holds.
Finally, let's talk about purpose-driven funds, specialty funds.
This is where you see funds that appeal to specific investor wants, beyond just pure financial return.
Socially responsible funds, or SRI.
Exactly. These let you align your money with your moral, political, or environmental beliefs by excluding certain sectors. And the source material makes a really fascinating point here.
Which is?
It says these investors are sometimes less concerned about the risk, since their primary goal is to support a cause or belief.
You see that in the exclusion lists. A sample fund might exclude alcohol, tobacco, and marijuana while still holding blue chips like Royal Bank or Apple. The mission comes first.
And this category also includes things like geographical or industry-specific funds. If you're in a fund that's only focused on emerging markets in Asia, your risk is highly concentrated.
You're betting on that region, and you're also taking on currency and political risks.
Right. And all this knowledge about classification and risk, it all leads to the ultimate mandate in this world: suitability.
The fair treatment of customers.
This is the legal and ethical core of it all. Agents have to act in good faith and always prioritize the client's interests over their own.
Even over things like a bigger commission.
Especially over that. They have to provide clear information, quality advice, and minimize unsuitable sales.
Okay, let's dig into the case study from our sources. Agent Claude and client Andre. This is where it all comes together.
So Andre comes to Claude with $500,000. He has two very clear needs. First, he wants his principal back when the contract matures.
He needs safety.
Total safety on the principal. Second, he needs a 6% net profit per year for his retirement income.
So safety plus a substantial, predictable income stream. But Claude knows his firm is paying a huge commission on their huge equity fund this quarter.
And that is the textbook conflict of interest. Claude has a personal incentive to sell that high commission fund.
But that would be completely wrong for Andre.
Completely. An equity fund has no guarantee on principal, and its income is volatile. Selling it would be a clear violation of the FTC rules.
So Claude has to ignore his own incentive. How does he use what we've just discussed to find the right solution for Andre?
Well, he analyzes Andre's needs. He needs safety, which points to fixed income, bonds, but he also needs to hit that 6% target, which requires some growth potential from equities.
So the suitable recommendation has to be a balanced fund.
A balanced fund, specifically one that emphasizes income. It uses bonds for that principal protection and steady income, but it adds some high-quality stocks to generate enough growth and dividends to get him toward that 6% goal.
All while smoothing out the volatility.
Precisely. Claude documents this. He explains why it's the best fit. And even if Andre rejects the advice, maybe he decides he wants to chase crypto or something,
Claude has still done his job.
he has fulfilled his professional and ethical duty under the suitability rule.
That rule really is the shield that makes sure the investor's goals are what drive the decision, not the agent's wallet.
It's the core mandate. So what does this all mean for you, the learner? We've gone from the near certainty of money market funds all the way to the high-risk world of specialized equity.
And the lesson seems pretty clear. Ignore the fancy marketing name on the fund. You have to focus on the underlying parts. Is it cash? Is it bonds? Is it stocks? And in what proportions?
That fund facts document is your essential tool. It lets you measure the real risk and make sure it actually suits your needs.
Which brings us to a final provocative thought.
Right. We noted that investors in specialty funds, like socially responsible ones, are sometimes less concerned about the risk because their main goal is to support a cause. This raises a really important question for you, the investor.
When you prioritize non-financial goals, moral, political, environmental alignment, how do you weigh that objective against the fundamental duty of financial suitability to ensure your own long-term financial safety?
It's a balance every single purpose-driven investor has to define for themselves.